Great. Good afternoon, ladies and gentlemen. Thank you for making time to listen today about NuVista Energy, and thanks Garrett and thanks EnerCom for hosting us. It's great to be down here and able to talk about what I think is a great business. It's an exciting time to be talking about NuVista Energy. So let's dive right into it. So you can see here, this is a corporate snapshot. So we've passed through 80,000, actually 85,000 BOEs per day now of production. About 2/3 natural gas and about 1/3 condensate, which is a very light form of oil, as you probably know. And it's interesting, we get such a good profit on the condensate because it's used as a diluent for the oil sands. So it's finally the one product we're at the correct end of the pipe for in Canada. We don't have to export it, we're actually importing it from Chicago and the US Gulf Coast. So we get a premium price. As a result, that's 1/3 of our production, but it's actually 2/3 of our cash flow and is a big driver of our economics. I won't read all these numbers to you, but as you can see, we're in a very, very strong position, spending about $450 million per year. And I'd say the snapshot is we're getting closer to zero debt now. We have almost nothing, 0.3 times net debt to cash flow. And we're growing about 10 to 15% CAGR per year on an absolute basis. We're buying back 5 or 10% of our shares per year. We're reducing debt. And all of that can happen because the payback on our wells is so rapid and the results are so highly repeatable. We're only spending about 2/3 of cash flow in order to do that growth. So it's been a great business, and I've got a few slides on each of these topics. We just started returning cash to shareholders about a year ago, and we've already returned $220 million, and we're continuing on with our NCIB, which is the Canadian equivalent of how you give money back to shareholders if you're buying shares. I do have to point out we're going to be talking about forward-looking information, so please take the advisories under wrap. So these are the pillars to our growth, and I will not, and to our value strategy. I won't spend too much time on each because I've got one or two slides for each of these. And but you can see it's all about top quality assets, and you got to execute and execute well. Financial strength and a strong balance sheet. We've chosen a disciplined and an optimal growth profile. Just drilling with 3 rigs, a very, very stable and comfortable pace, which gives us a lot of flexibility. And of course, we've had some excellent sustainability results, including methane reduction and greenhouse gas emissions reductions. You got to have a deep inventory these days if you want to be in the game for a long period of time, and that we have. So much like the Permian, we have multiple benches. That's why we show this map 4 times. From the left, the blue, heading towards the right, that's the lower Montney A bench, and then the middle Montney B above it, and then the C, and then the D. So we have 2 to 4 layers that we're drilling in every single one of our pads, and multiple opportunities, most of it delineated, but still some positive surprises coming along the way with extra zones. And the numbers on the bottom right-hand side kind of tell the story. We've been at it for 13 years now. We've drilled 300 wells. We're drilling about 45 wells per year to grow between 15 and 20% per year. And we have 1,100 wells left to drill in our 2P reserves, undrilled, and our contingent resources. But of course, it's not just about inventory, it has to be very high quality inventory, and I'm going to show you some of the tremendous economics that go with the drilling of these wells. So you can see here, we've split our assets into 2. They're all very close to the city of Grand Prairie, within a 30 to 60 minute drive. Got all the oil and gas services we need there. It's a major oil and gas center, and that's about 4 hours northwest of Edmonton, for those of you that know that area. So this is the northern portion of our asset base, the northern half, and it's about half our production. And you can see we've got 2 assets in this area, Pipestone North and Pipestone South. And you can see we're in good company. We're surrounded by a lot of wells. So there's a lot of well control. Canadian Natural Resources, Ovintiv, Pipestone Energy, and others are around us. So not too many surprises. We're having lots of good repeatable results. And as you can see from the green pads, we're just drilling pads, in this case across all 4 zones, right beside existing known result pads. And so it's highly repeatable. We're just moving 1 pad at a time, heading towards the south from the top of our land base there. And we are getting these tremendous results. You can see here the most recent IP30, just another one of many that we keep putting out there, the 9036 pad at Pipestone South, just under 7 million cubic feet a day and 130 for a condensate gas ratio. So that's over 900 to 950 barrels per day of condensate per well on the pad. This is why we're getting such rapid payouts. And on the top right, we're showing the actual results. This is not a highlight reel. This is every pad we've drilled in the last 3.5 years since being in this area. And you can see what we're showing here is the payout multiple, because our payouts are so much faster than 1 year. It makes more sense to say, well, how many times in the first 12 months do we get our money back from drilling a pad? So each of those is a pad, not a well. And so each is about $50 million, between 4 and 12 wells on a pad. And you can see the numbers range 1.5 to 3 times. And we got some that really kill it and some that are a little below average, but the average across the piece is a tremendous 1.5 to 3 times our money back. So we drill, we spend $50 million, we get back $100 to $150 million within the first 12 months. And that's why we're able to grow the company rapidly while still having highly repeatable results and returning cash to shareholders at the same time. So one point of pride we wanted to kind of point out is when in 2018 we did our one and only major acquisition. Everything else has been organic through the drill bit, and we went in and purchased that Pipestone North property that I just showed you after having drilled for 7 years in our other properties and recognizing early the value of that property. And we paid 625 million Canadian dollars for it, and we were discounted immediately after that. And the market said to us, you paid too much for it, and we don't think it's as good as you said it was. And we're very pleased to be able to show that we have far exceeded the expectations that we put out there when we purchased this property. And in fact, this quarter, we're passing full cycle payout. So that's $1.4 billion, almost half of which for the acquisition and the rest for the drilling and the facilities since then. And despite having pandemic pricing in the middle of that 5-year period, we have full cycle payout and 20 to 30 more years of drilling yet to do at half cycle. So it's been an absolutely tremendous acquisition for the company and is a big part of our growth to 105,000 BOEs per day, which is our target. So we have our southern properties as well. They're called Wapiti. Some of you might know them as Bilbo and Gold Creek and Elmworth, but that is the entire area called Wapiti when you combine them all together. And same thing here, except we've been drilling for 13 years in this area, and so you can see we just continue to put out those results. We get similar results to Pipestone North and South, but the wells cost a little bit more down here. That's part of the reason we entered Pipestone area a few years ago. And so the results and the returns are excellent, just not quite as strong as the Pipestone North and South area. And you can see on the right-hand side, this is every pad that we've done in this area for the last 3 years. And even though we're 13 years in now, we're still getting 1.25 to 1.75 times our money back in the first year. So very pleased with the continued progress here. And we continue to add more reserves. We've got contingent resource. I mentioned some pretty big numbers there with excellent economics, as I've just shown you. But actually, we still have new zones being developed. So in this area, Gold Creek, the blue area, we had been drilling mainly just in the B layer, and we never had booked any reserves for the other zones. And we have now drilled wells at the north and south end of the blue shaded area in the lower zone, the A zone. And we have offsetting wells from Paramount Resources. And so this is getting to be a well-proven zone now, and we're now drilling it on every pad and starting to move those 100 locations from contingent resource into reserves, continuing to grow that reserves future with very pleasing results. Cost is really important, and I'm really proud of our teams. They've done such a good job of structurally reducing the cost over time, and the main way you do that is by drilling faster and fracking with less pumping hours and less sand and less water. And that's what we've been able to do. And you can see since 2012, basically the short version of this slide is we've dropped our costs in half. We got them down as low as $5.9 million per well Canadian to drill, complete, equip, and tie in. And then, of course, you can see in 2021 through to 2023, yes, we've had some inflation kicking back in, and we've been able to offset some of that inflation with continued efficiency improvements. But of course, you can't completely escape the inflation. But the thing I want to point out, if you stare at this slide later, which is on our website, you will notice that we're still drilling our wells now for less cost per well than we were in 2019 before any of the inflation started. And I don't think there's a company out there that can probably say that. One of the reasons, we keep having breakthroughs. So we've been getting our well time to drill, spud to TD, down to 12 days, even as low as 10 days In the northern property, which is shallower and easier to drill, that's the Pipestone area, we had never gotten below about 17 to 21 days in the southern area, Wapiti. We took some of the learnings in the northern area with monobore drilling and different type of drilling bits and muds, and also the lower Montney drills rather quickly. It just is easier to drill. And so in the southern area here, you can see we've dropped from the 18 days to the last pad is the orange one. That's all 6 wells drilled for an average of 12 days per well. And the pace setter on that pad was 10 days. So this is what's driving our costs downwards, helping to offset some of the inflation that we've all experienced. I'm going to skip over the type curves. You're welcome to look at those in our presentation, but I just showed you what's better than type curves, which is actuals for the last 3 years. Very compelling. And this is what it all adds up to. If you're spending 450 to 500 million Canadian per year, we're able to grow with the 3 drilling rigs at a 10 to 15% CAGR. Last year we grew at 30%, but of course the bigger you get, the slower you grow with the same rig count. So we're very pleased with this steady pace of execution. And like I said, spending about 2/3 of cash flow and the rest being returned to shareholders and debt reduction. And really the gray shaded area is the capacity of the facilities that we've built and also tied into with midstreamers. And that's what's available to us. And we're growing nicely into it with the pace that we've chosen. And then the dark blue bars with the white shaded at the top, that's our growth plan based on spending 450 to 500 million per year. And so you can see it's a nice steady growth to 2026. And really you're kind of there by mid to late 2025. It's just that 26 you get a full year at the plateau rate. And you might wonder, aren't you working on increasing that plateau rate even further? And of course the answer is yes. As we move those wells from contingent resource into reserves, as I talked about, we continue to work on facility expansion and debottlenecking, and we are continuing to work on a plan which takes us beyond 105. Our land base, without any more land, could easily withstand 115 to 125,000 BOEs per day. And the way we measure that is we always want to maintain, once we reach plateau, we want to have a minimum of 10 to 15 years of drilling inventory thereafter to keep it flat. And so the more we grow our inventory, the more we're able to grow our forward growth plan beyond 2026. Okay, so this is the other part of that growth plan, which is, of course, on the right-hand side, the spending. I talked about 450 to 500. We always used to talk about $450 million a year, but with inflation kicking in the last few years, we've increased that slightly, as you can see. We'll see if we get any deflation kicking in. It's looking better now. On the left-hand side, if you're only spending about 2/3 of cash flow, then what's left over is your free adjusted funds flow or your free cash flow. And you can see that is a very, very strong return coming back. Our debt levels are already under $200 million. So with 700 or 800 million per year in cash flow, that's a very, very low net debt to cash flow ratio. And obviously we're not going to take debt below 0. So at some point, right now we've been returning 75% of our free cash flow net of capital to shareholders through buybacks. And at some point we may have to consider increasing that number, because obviously we don't need to keep debt going down all the way to 0 or below 0. So in that time, we'll have grown the company 50% in production to 105,000 BOEs per day, reliably and repeatably with high value drilling. And of course, during that time, at the current kind of price scenario we have up there, which is 85 oil and $4 NYMEX, we'll have returned $9 per share in free adjusted funds flow. So growing while returning is kind of the mantra for us. I'm going to skip over this one. It just gives you sensitivities at different prices if you want to plug in all the way down to 65 West Texas and $3 NYMEX gas. And then I've really kind of covered the debt. You can see, the pandemic was something I think probably none of us that run oil and gas companies want to ever experience again with any measurable debt levels. And so that's why our leadership team and our board have agreed that we've lowered our debt targets significantly. And of course, we've already surpassed that goal. So very happy to be at a very, very flexible point from a debt perspective. I did mention condensate. We're finally at the correct end of the pipe for one product. We're importing it, so that means we get the premium pricing. So typically in the winter, we get a $3 to $5 premium to West Texas for the condensate that we produce. And in the summer, we get a $3 to $5 discount just because it is seasonal how much of the condensate you need in order to blend with the heavy oil from the oil sands in order to allow it to be piped down the pipelines, pumped down the pipelines. So that's really what the graph on the excuse me, on the right-hand side is showing. The dark blue bars is the supply of condensate, and the little red line at the top is the demand for condensate from the oil sands producers, and you can see that gap, and that gap is our friend. So over here, this is the natural gas. So I said it's only a third of our cash flow, but it's 2/3 of our production, and we definitely want to get the best price for it. And I would say that for any producer our size, we are the most diversified for natural gas sales. We've been at this for 13 years, and we always wanted to have diversified sales across all of North America. And so we've got contracts that you just can't get anymore, and they're renewable. So we continue to renew those pipeline egress contracts. So probably a little hard to read from where you are. You can refer to it later, but really if you look at 24 and 25, because there's almost no hedges in there, which complicates the story to tell, you can see the different colors, and those are what we call the 5 points of North America. So we're shipping about a fifth of our gas to each of California, that's Malin, California-Oregon border, to Dawn, Ontario, to Chicago. About a fifth of it stays in Alberta with the AECO market, and then of course about a fifth of it to the US Gulf Coast. And all of those are pipeline contracts which are renewable. Almost all of them are renewable, and they are pipeline contracts. The only exception is the US Gulf Coast, where we use financial basis differential contracts out to 2028 and 2029 so far, in order to virtually get the gas price placed there. Hedging, we used to do a fair bit when we had higher debt levels and higher spend levels relative to cash flow. Now we have flexibility in every direction, so hedging is really just a question of opportunism. We currently still have a few gas hedges with $4 Canadian by $7 Canadian costless collar, ceiling, and floors. So that's a good thing now that natural gas prices have come down. But generally, we're not needing to do hedging unless it's opportunistically value add for us. And I'll give you an example. A year ago, when natural gas prices were ripping, we were laying in some 4 by $12 and 4 by $15 US NYMEX costless collars. That was a tremendous risk skew to the upside, so we took advantage of it. Quick word on ESG. I just want to say that Canada has very, very tight environmental regulations to start with, and so I like to think that we've very much been a leader in that, though. For a small company, I think we've punched well above our weight. We've reduced our greenhouse gas emissions per BOE of production by 60% since 2012. This has come from shifting our business into the much more efficient Montney, which is good, clean Canadian natural gas, but it's also the fact that not only is it more efficient, we've done a number of projects to ensure that our emissions are reducing. We've run instrument air lines to our new pads in the Pipestone area because we had the pipeline ditch open anyway, so it's very inexpensive to do that. So now we have instrument air supply instead of methane gas for supply, which is used for a lot of well sites, so no emissions there. We've installed waste heat recovery units. We're in the middle of installing a $50 million cogen project at our Wembley gas plant. So if you can't sleep tonight and you've got insomnia, you can read our 40-page ESG report, which goes through all of those items. We're very proud of our track record there, and we've done it very economically, in part using some of the carbon tax grant money that has been available in Canada to make these projects happen. So I think that's probably a good place to leave it. I think you can tell we're very excited about our business. We've worked very hard for 13 years to delineate the 4 zones, to acquire opportunistically and early, to build the facilities, and then to weather the storm of the pandemic, and then to reduce debt. And so as you find us today, we are drilling on a steady basis, returning significant economic returns with highly repeatable nature to them, and a deep inventory to drill. So it's a very exciting time. I'm very proud of the teams that have worked so hard to make this happen, and I very much look forward to seeing any of you if you want to come to the breakout room and we can talk about any questions. So thank you very much for your time, and thank you again, EnerCom, for hosting us.